All right, everyone. Today's quick thought is going to be about how interest rate hikes, the things that I keep talking about that come from the Federal Reserve, how they actually affect your day-to-day life. You might not think that they actually do. You keep saying, "Oh, that's for the banks and this other stuff, and that's for that." What it really is it is an interest rate in which the banks have to pay to borrow money, okay? It's also an interest rate on how our debt, the United States debt, is paid. So if it goes up 1%, the interest rate that our country collectively have to pay in taxes go up on that debt. It goes up 1% on the interest rate from that debt that we have to pay back. Okay, now you say all of that, that's great, but how does that affect me? Very simply, it affects you via any line of credit that you have. If you have a credit card, if you have, so there are two different types of debt. Okay, there's going to be a revolving credit, and there's going to be an installment credit. Okay, now this is stuff that very basic that you and I will on a day-to-day basis pay. It could be like an installment payment is going to be something like a car. Something that you will pay the same amount of money every single month for a set number of months with an exact payoff date. It's a predetermined payoff date. Now, revolving credit, something like a line of credit, something like a credit card, is going to be a little bit different. Okay, it is not determined. It is determined because though you might have a credit limit, all right. You don't have to spend it all. There is no determined date. You can spend $100 of your $10,000 credit limit, or you can spend all $10,000. That is completely up to you. So that's why the banks actually do treat this a little bit differently. It is a little bit riskier. So you say, quick, how do these interest rates affect me? Very simply, the prime rate. The prime rate is linked to the APR on your credit card. I promise you, if you got a credit card, recently, and then this is a credit card that you could have had for years, but if you got a credit card recently, and let's say that they set you up with a 9% interest rate, okay? You set up 9% APR, man, I did pretty good. I promise you, it's been going up. Within the last 2 years, if you've had a credit card that long, you could see the difference. Today, it's going to continuously be higher when you first get it. It's called the prime rate. The prime rate is the federal funds rate, okay? So let's do a simple math equation, not to bore you or get too complicated. Let's do a simple math equation in here to explain how that is. So there's a thing called a spread. Okay, the spread is what the bank makes on your credit card. Okay, on that actual interest rate payment. So let's say that right now the interest rate is right around 2.19% to 2.5%. Okay, let's just say it's 2.5%. Let's make the math really easy. The spread is 10%. Okay, now the bank could be a 14% spread. Really, actually, it depends on your creditworthiness, but there's at least going to be 2.5% for the prime rate, right? And then the spread, let's add a 10% spread. What does that make your APR? 12.5%, okay? Now, it's gone up. Now, your credit card, okay, has at least gone up 2% within the past 2 years, without a doubt. That's 2%. Now, how does that affect me, especially if from what I've been determining, if we're going to have an economic slowdown within coming up pretty soon, how is that going to affect you? Well, here would be the big issue. Let's say that interest rate goes actually pretty high, right? So the economy's going down, people are slowing down spending, right? Now you're paying more on that credit card. It's not going toward the principal, it's only going toward the bank. Well, technically, if they don't change their spread, the bank's getting the same amount, but the Federal Reserve is pulling that extra money out. They have to pay that, so you have to pay that. That's how this works. That's how the tariffs on China are affecting American citizens. When you say, oh, well, there's going to be a 10% tariff coming in, well, who pays it? Well, it's a tax that the Chinese have to pay, bringing in these imports. And then for us to purchase that, we have to pay that back, that extra 10%. So we pay it. So once again, make it really simple. There's a prime rate, which is actually directly linked to the federal funds rate. It's going to be the same number, okay, pretty much. And then that is put on top of that company's spread, okay, that bank's spread. Once again, right now it's around 2.5%. They're saying that it's going to be 3%, that the federal funds rate is going to be 3% by next summer. So we're going to see. We'll find out. That was a quick thought for the day. I hope that was very helpful. And once again, I appreciate you guys for watching. I seriously do. I hope to see some comments. Please leave some likes. Subscribe if you haven't yet and hit the notification bell. We'll talk to you guys soon.